Hello and welcome to Connect, the podcast of the California MBA, where strategy, innovation, and leadership come together to shape the future of mortgage finance. This is where voices and ideas driving our industry forward meet real world execution. I'm Paul Gigliotti, CEO of the California MBA. And if you're here, you care about building better for your business, your clients, and the future of housing. Before we begin, I'd like to sincerely and deeply thank our 2026 President Council sponsors whose support makes these conversations possible. That's AmeriHome, Consolidated Analytics, Loan DNA, Funding Shield, CMG Financial, Guild Mortgage, Rocket Mortgage, Wiener, Brodsky, Kidder, and Western Alliance Bank. It's quite a mouthful this year. So I want to thank all of our President Council sponsors again. Let's jump into our conversation. Today's conversation is a very important one and something we're all keeping our eyes on right now, especially in California. For private lenders and all the others operating in California, we're talking about what happens when loans go sideways, and it does happen. And let's be honest, nobody originates a loan hoping it becomes a legal strategy session, right? That's usually not the dream. The dream is home ownership and building equity, et cetera. But in the real world, default happens, projections stall, borrowers drop communicating, collateral gets complicated, timelines get stretched, and lenders need to know how to protect themselves, protect the asset, and make smart decisions before the problem gets worse. It's a lot of complication. So today we're going to talk about practical guidance for managing defaults, protecting collateral, and maximizing recovery. And we've got a brilliant guest on our Connect podcast, Steve from Forta Law. Steve, thank you so much for joining us.
Oh, that was very generous. Thank you, Paul. I'm glad to be here.
What the generous part was calling you brilliant? Come on, man. You keep your eye on all this stuff, and it's a ton of moving parts. And you bring such a deep experience in litigation, enforcement, creditor rights, and helping lenders navigate the moments when loans are no longer servicing issues. It's a legal operation and business decision. That's a lot. That's a lot of understanding. So I'll leave that brilliant label on you, my friend.
I appreciate it. Thank you.
We've got a lot to talk about, and so let's dive in. We're going to start with when a private lender hears the phrase a loan is going sideways, that can mean a lot of different things. It could mean missing payments, stalled construction projects, a borrower dispute, title issues, collateral problems, bankruptcy. There's a whole litany. From your perspective, Steve, what is the most common ways private lenders' loans start to go wrong in California? What are you seeing out there?
Yeah. So the easy ones are the payment defaults. Those are the easy ones to spot. Those are the easiest ones to prove. Like you're supposed to make a payment every month, and we haven't had one since February. Like there's only one
Yeah.
defense to that, and it's yes, I have, and here's the canceled check. So those are the easy ones. The non-monetary defaults, just as important and just as enforceable, harder to prove, and those are I didn't renew my insurance, which is a big one in California with
Yeah.
fires and earthquakes and problems like that. So making sure they're monitoring the insurance premiums and the viability of insurance is important. And if somebody is running out of money, the places they're going to stop paying the other sort of vendors or creditors are their taxes and their insurance. Those are the first two places because the taxes are slower to report and the insurance sometimes doesn't report at all. So those
Yeah.
are two big ones to look for that are important.
What are the early warning signs lenders should not ignore? So let's keep on track with those two main issues. That's payment default, not making payments, and then lack of insurance and maybe property taxes. What are some early signs that a lender could look for to kind of keep in the preview?
Yeah. So if you get an NOD from somebody else, if there's a senior creditor, that's a big one. If they're not paying you and they're not paying your senior, I think it's fair to say that the whole world is going sideways on that project. Second, if you start to see mechanics liens, especially big ones. Like if there's a small problem with the guy who's delivering the porta potties, I'm not so concerned about that. But if somebody gives you a $65,000 mechanics lien because they didn't pay the cementologist, which is a great word, who came to pour the foundation, I think you got a big problem, and you need to start
Yeah.
to look into what the person is doing with the draws or how they're managing their project.
I have a question for you. You had mentioned the notice of default if there's a senior lien. As the junior lien, do you get any other notification other than a notice of default? Do the senior liens let junior know if like one payment was missed, or is it just boom, notice of default is being filed?
Yeah, the NOD is probably going to be the first notice that you get. And then 3 months later, if they don't solve the problem, you're going to get the notice of sale. And then you've got a really short period of time to work everything
Short
out.
window.
So,
Yeah.
yeah, when you get the NOD, it's time to alert some people and get your borrower on the phone and probably get in touch with the senior if they'll communicate with you and figure out what you're going to do because the news typically continues to get worse.
I know on the and I don't want to stick on this issue because we have a lot to talk about, but I know on the residential side, if there's a first mortgage and a second mortgage, and the first mortgage notifies the second of notice of default, it becomes irrelevant, really. Like the second lien position gets gobbled up. Like first is in first position. And if there's any money or any, you know, equity in the property or liquidity, it goes to the first, right? So is that basically what you're saying?
Mostly yes. So the first is going to wipe out the collateral security rights of the second. So the
Yeah.
second is going to become an unsecured creditor, just like someone's Visa card or anybody else who doesn't have any collateral. If there's excess proceeds, there's a whole rubric in 2924 that's going to determine how those excess proceeds are distributed, and the junior mortgage holders are usually going to take a lot of that money, but oftentimes there's no excess proceeds to distribute.
Right, right. So let's move into default management. One thing I always think about is that first response often shapes the entire outcome. When a borrower defaults, a lender may be trying to preserve the relationship, understand the facts, protect, obviously, the collateral, and avoid making the situation worse than it already is. What should private lenders be doing in those early days after default? And what are the first steps that you think being in the industry or doing what it is that you do for so long matter the most?
Yeah, so this is, I think, the same as I'll call it advice I give to the lawyers who work for me. When something happens, you can't just call somebody or do something and then stick the file back on the shelf. Same with your loan. If somebody's defaulted, the first thing you want to do is make contact with them, reach out and touch them. Hey, this was a performing loan for 16 years or 16 months or whatever. I didn't get a payment last month. What's going on? The borrower will be ready with a story. It's a problem with the bank, or the ACH transfer didn't come, or somebody bounced a check to me and I'm going to have it solved in a week. Whatever the story is, they're going to have one that's ready for you, that is ostensibly believable enough. Um, but it also has a deadline, and you have to calendar. All right, they said they're going to have the payment to me in 7 months. I'm going to count, or I'm sorry, in 7 days. I'm going to calendar this for 10 days. I'm going to call them back if I don't have the money. And when you call them back in 10 days, you're probably going to get a story that's a little bit different, but is mostly the same. Like, I don't have it and I'm not giving it to you. And at that point, you've got a borrower who's telling you ghost stories, and you have to sort of get real about what we're going to do, because what they're trying to do is buy time. Like, they want to
Mhm.
not pay you for as long as they can, and you want them to pay you as quickly as you can. And there's always concerns. Well, I don't really want to take back this property, or, well, I don't want to spend the money to sue them and get an assignment of rents order and do all of these things. But you have to have a plan, and then the plan cannot be, I'm going to wait 90 days and see if the money shows up. That's not a plan. That's just hope. And my wife, early on in our marriage, described to me the following. She said, hope is not a strategy. And she's absolutely right about that. So
Yeah.
if you want your money, which is sort of the reason most people are in lending, you got to make a plan, like touch your customer, give them one shot at the bounce check, 7 days, whatever it is, I'm going to solve it. And if that doesn't work, you have to start implementing a plan and stick to it.
Yeah. I love that hope is not a strategy. There's something to be said about that because, when you follow the life of abundance and prosperity, you have a certain you want to have a certain belief mechanism on a personal level that when you do the right thing and you're diligent and you have like a focus on being careful and crafting and living the life that you want to live, it's not hope, but things will happen the way they're supposed to happen. But in business, you can be the same, have the same functionality and mindset with like your team or your partners or your customers. But behind that needs to be a workflow or a strategic workflow or a strategy behind what are you going to do when X happens? What are you going to do when Y happens? And I think it's really important for us right now as a community in the residential and commercial space to have focus on, we're here to do the right thing and we have to ensure that we're supporting our consumer, whoever that is, but we also have to make sure that they're doing the right thing as well. And so there has to be guardrails behind that. And oftentimes, especially when natural disasters pop up or circumstances that are out of control with, COVID or, hard economic times, circumstances occur and you maybe can shift a little bit, but you still have to follow a strategy. So your wife had something there to that, and I'll remember that. That's good.
Yeah.
Hope that, you need that strategy in there. So as we're talking about strategy, I want to talk about discipline and or file discipline and documentation. I come to the California MBA with a long-standing of operating a mid-sized IMB as a COO. So I'm very like process procedure oriented as a person. And I can't tell you how many times I've had conversations with underwriters about the importance of having documentation in a file, not just for reps and warrants purposes from an agency, but what if something happens and that file comes back to us for default, right? So can you share with us, and that being said, a mortgage tells a story. So when a loan becomes disputed or moves forward toward enforcement, how important is it that the lender has certain documentation in the file to, have something to fall back on? Communication with borrowers, default notice, payment history, construction progress, draw requests, all that stuff.
Right. So when a file gets referred to me, I always sort of my closing line in the email to the client are these are the three things I need. I need the promissory note, and let's hope that it's signed by everybody. I need the deed of trust. Same thing, it has to be signed, and you really hope that it's recorded in the correct county. I've had this one a couple of times. They recorded in the wrong county. Now you're an unsecured creditor, just like somebody's Visa card. Makes it a lot tougher. And
Yeah.
then I want a payment history, which in the bottom right corner has the balance that you want me to sue for with two black lines underneath it. Like I want the lender to decide today exactly how much they're going to sue for, because in a year and a half, when I have a blow up in front of the judge or jury and I'm telling them how much we're seeking, if we ran the payoff history yesterday, the day before the trial, it's going to come out differently because your computers are attributing interest and late fees and things. And then we have to explain to them, well, this isn't the right number, but here's how we back into it. If I got it the day that I filed the lawsuit, it's correct and I can keep that one forever. So those are the three things that I want.
Okay. So those are the important things for anybody listening. Those three things always have to be in the file and executed, completed 100%. That's what they need, right?
Yeah.
Yeah.
Yeah. And so that's the collection side. The when lenders get themselves sued, the sort of two hot things that borrowers are suing lenders for are elder abuse, which is a good one because there was a time in my life when I thought 65 was old. I don't think that anymore, but it still qualifies for elder abuse. And I get private lender clients who are older than the borrower who's suing them being sued for elder abuse. There's that one. I didn't understand the documents, the character and contents of the documents that I signed. It's 133 pages. I signed my name 47 times, and it took 2 minutes and 35 seconds that I was with the notary. So there's no way I read all of that. There's a rich history in California and plenty of case law that says that doesn't matter. You're charged with understanding the things that you signed. But when I don't speak English well enough, or I don't read English at all, or elder abuse. Those are kind of the three things. And what you'd like to have in your file is something written by the borrower's own handwriting that says, I can read and write and understand English. If they write that in there, super tough for them to
Right.
claim that they don't later on. And then with the elder abuse one, if you have someone who's in that, what others than me call advanced age now, you probably want to have a family member or somebody, at the very least, the notary, asking them and attesting that they sat there, they seem to understand the nature and character of the things that were happening around them at the time of closing.
Yeah, that makes a lot of sense. So you brought up California. Let's talk specifically about California for a hot second. It's not always the easiest state to operate in, especially for financing, consumer financing, or really any other business. And I say that with all the love in the world. It is the Golden State. But private lenders here in California have to think about borrower protection, foreclosure rules, servicing rules, licensing, disclosures, business purpose lending, consumer purpose lending, and a very active legal and regulatory environment, especially with this newer division with Chopra coming in and now having a little bit more oversight alongside the DFPI. What are some California specific issues private lenders need to be especially aware of when managing default or enforcement? And I know that might sound like, oh my gosh, do we have 3 hours on this podcast? But just some of the outliers from your perspective.
Yeah, so the licensing is important. And
Okay.
if you're not a California specific lender, you probably don't understand when you need a license and when you don't. So figuring out if you need one and what kind is real important. And there's not a sort of all inclusive answer for you. It depends a lot on what kind of loans you're issuing and how many of them and things like that. So that's a big one. And the real benefit, say, of having a license in California is usury. So the usury, California is a very beneficial or conciliatory state to borrowers with just about every issue except usury. So many of the states have more stringent usury laws than California does. In California, the usury percentage is 10, which is kind of high nationwide. But when you get finished applying all of the exceptions to usury in California, there's not much usury statute left. So usually someone is going to qualify for one of the exceptions. The big one is a license.
Okay.
If you have a license, you're not subject to usury in most circumstances. So getting a license is going to allow you to charge more than 10%. I think in today's market, I don't know if this is an evergreen video, but we're sitting here during June of 2026, and the marketplace is generally going to have loans that are north in interest rate of 10%. I think probably
Right.
12 is about the standard one right now.
Mhm.
And so you can't issue a 12% loan unless you're exempt from usury somehow. And if you're not exempt and you do issue a loan at just 10.01%, what happens? Does it go down to 10%? It doesn't. The penalties are extraordinarily punitive in California. What they do is reduce your interest rate from whatever it is to zero. Your interest rate becomes zero, and 100% of the payments that have been made on the loan are applied exclusively to principal. I don't care what your amortization schedule says. I don't care
Wow.
what your late fees were charged. Everything your customer paid to you is applied to principal, and your interest rate is 0%. So you're going to get your money back, but you're not going to have made any money on the loan, and the
Right.
time value of your money and all your efforts and all those things are going to have been wasted. So looking out for the license that you have and whether it's the right one, so that you don't get stung by usury claims, are really important, because we see plenty. It's sort of a frequent sword that borrowers use to defend themselves in payment default cases, is to claim elder abuse, usury, the H-Bor violations, things like that.
Is that like that in any other state, or is that specific just to California?
The numerosity of the exceptions to usury are,
Yes.
I think, greater in California. There are
Okay.
more exceptions to usury in California than there are in other states, which is a little bit surprising, because most lenders either avoid California or avoid, to the degree they can, the application of California law, except with the one issue of usury. People from other states are trying, as they may, to adopt California's usury rubric because it's lender favorable.
All right. That makes sense. That's a great tip. And again, the reason why I called you intelligent, look at all that information you just threw at us. Excuse me. Before we wrap up, Steve, real quick, I want to talk about looking ahead. What do you think private lenders, or forward looking, I guess that's looking ahead. What do you think private lenders in California should be paying closer attention to in the next 12 to 24 months?
We talked about this one in your first question, so we'll sort of bookend the interview this way. Insurance is a big one.
Okay.
Any lender anywhere who has access to the internet or a television knows that we had some wildfires here a year ago.
Hmm.
We haven't had a big earthquake in quite some time, which, this isn't science from the California Institute of Technology, but when we haven't had one for a long time, it probably means we're going to have one. And I was born here and lived here most of my life. And when it gets really hot outside, I call that earthquake weather. And those big ones happen, in the 10 freeway collapses, or you get, the Palisades burned down last year. When an earthquake comes, you can get an entire city where everything is razed, and people probably don't carry that much insurance. Is there a risk in the insurance industry that the insurance industry doesn't have enough money to cover all of those things? Housing prices are somewhat outrageously high in California, and if you lose an entire city of residences, does Lloyd's of London have enough money to pay that all back? I don't know. There's be an interesting thing to find out that I hope we never have to, but it's kind of like, is there really enough gold in Fort Knox to support all of the currency that we have? I don't know the answer to the question. Hope we never have to find out.
Hmm. That's something that is very top of mind for many businesses and residents in the state of California. Not the gold in Fort Knox, but insurance, as we were saying when
Yeah.
we first opened, because it is a little scary. It's a very unknown, and it really hasn't been an issue to the consumer up until recently, up until recent years. So it is definitely an unknown, and great point. Steve, as I was expecting, this was a great conversation. I really appreciate your perspective and the work Forta Law is doing to help lenders navigate these difficult and important situations. I also really appreciate our partnership with the California MBA and Forta Law, and you yourself. So thank you for your time. For our listeners, the takeaway is simple: when a loan goes sideways, um, as you were saying, hope is not a strategy. Your wife hit the nail on the head with that one. Lenders need documentation, discipline, communication, documenting that communication, a clear understanding of their collateral, and a plan for protecting their position before the situation gets any worse. So I want to thank you for your time, Steve, for being here. And to our audience, thank you for tuning in to Connect, where advocacy is constant, education is constant. And in a market like this, execution matters now more than ever. So thank you for being here, Steve. Um, and until next time, stay engaged, stay sharp, and keep building with purpose.